G'day expats and welcome to another episode. As always, I'm joined with my co-host, Jeremy Harper. Good morning, mate. How are you?
Morning, James. Very well, thank you. Today we are sort of on the eve or the week before the March RBA announcement. So
That's
we've talked
right.
about the RBA previously, so we won't go into too much detail, but by the time this comes out, we will know what they've done.
That's right. And I mean, the decision is likely going to be an increase just due to, unfortunately, a lot of the Middle East conflict causing a lot of inflation, especially within that oil, gas, energy sector. So I think some of the numbers that they have put out recently from a lot of economists is that inflation is likely to tack up to about 5% before it starts tacking back down. So the RBA is not really faced with an easy decision, but probably the only decision would be to go up to try and cut spending, so the demand comes down. But it's a really tough one. The longer that Middle East conflict goes on, the longer I'd say that inflation is going to hang around. We do need to be mindful that the December quarter's GDP figures in Australia were really strong in terms of economic growth, strongest they've been in a couple of years now. So the economy is growing, which is a good signal, but need to tackle this inflation before it runs away again. So I'd
Mm.
expect by the time this episode comes out, we have seen a 0.25% increase.
Interesting. Okay. And
Yep.
still nothing from the government on their end yet.
Oh, yeah, we're waiting on the budget, and that leads us to today's topic. We're going to talk
Of
about,
budget changes. Yes.
yes, some capital gains tax reform. I think they're fast approaching. We've just seen some tax reform in the background regarding Division 296 on the additional tax for superannuation when your balance is over 3 million on the earnings. And then again, if it's over 10 million, a more punitive tax. Those figures will be indexed, but I've got some clients which will be impacted by that immediately as soon as it comes into effect. But at least now they've updated it to ordinary concepts. So not paying tax on unrealized gains, paying tax on actual realized gains income when you're above that threshold. Now, the CGT, capital gains tax reform that we might be seeing now, and they've drip fed it out. It's around the CGT discount, sorry, but I thought we'll pause there and take a look back at and discuss for our listeners, like a lot of the concessions they currently don't get access to.
Yes, that's
Yep.
right. So if you're an expat listening to this and you're a non-tax resident, I think that's the key takeaway. You don't have access to this at all. So I guess the first message to take away is just take a deep breath. It's going to be okay. This is not going to impact you. So if you have property in Australia, don't rush out and sell, or unless that's something that's part of your plans. Um, you know, don't be part of potentially like that shit mentality where everyone dives in and does the same thing, because ultimately that's going to work out to be not a great financial outcome for yourself if you're not thinking about yourself and how does this impact you as a Australian expat.
Yeah, and just remember, something that's announced in a budget can take a lot of time to be legislated. We've seen that time and time again. They announce it, and it has obviously its due process to be
Hmm.
legislated.
Yep.
And if they're playing with CGT discount reforms or any of that nature, that's going to take a while. Based on the current government design, getting the Greens on side, what's going on with the coalition in inverted commas, and then you've also got the One Nation party as well. So there's a lot going on in terms of how they would try and get a lot of this proposed legislation through. But we're mainly reading from the tea leaves here. There's been nothing drafted, but it's
Yep.
what we expect this
Yes.
time, this year, this budget.
That's right. So on a previous episode, we've talked about how they like to drip feed this information into the market, get a feel for it.
Hmm.
It seems to be, as you mentioned earlier about the superannuation changes, the Greens have sort of rubber stamped those changes with, and they came out and said, yes, we'll green light these changes, but we want to see substantial changes around the capital gains. So
Hmm.
whatever does come out in the next couple of months, it looks like the Greens will support that. And if you think about that from the upper and lower, it pretty much gives them the majority. But of course, things can change into the future. But let's talk about, I guess, capital gains discount. What is it? Why have we got this 50% discount rate? Do we want to go back again and talk about what used to be in place, the indexation rules?
Ooh, that's a good one. Gosh, you're going back, going right back there. Haven't heard someone quote the indexation rules for working out a CGT discount for a very long time. But yes, that's probably a good place to start as to where it all started. Remember, CGT hasn't been around forever. CGT was brought into the late 80s, capital gains tax.
Yep.
So some, obviously families, some households still own pre-CGT assets, which means when they sell them, they won't actually have to pay any tax, which is remarkable. There wouldn't be too many assets getting around like that anymore. But then the first method for working out some sort of discount was the indexation method, and that was applying it to the cost base. So we can unpack that a little bit for sure.
Yep. And I guess if you think about that, that was adjusting the cost base for inflation. So for the longer you held that asset, that will adjust up the cost base to reflect what the current value of the cost base is. So you're not paying gains on the old dollar figure. You're paying gains that you've made on the sale or disposal of that asset in today's value. What happened was that became very complex because obviously that was tied to the CPI, if I'm correct, figure.
Yep. Yeah, it
Now
was. Yep.
that would change every year. That's obviously down to an exact decimal point. So before the use of computers was generally used, people would get that calculation wrong all the time. So then if you think about it, they've replaced that with this capital gains discount model where if you held the asset for more than 12 months and you dispose of it in your personal name, they'll give you a 50% discount to sort of work out and say, okay, you've held this for a large period of time. There's the discount, and then you'll pay tax on the net gains of that.
That's exactly right. Yeah, exactly right. So there's obviously cost-based adjustments that go into it, but it's a much simpler way to work it out. The indexation method became very difficult for accountants to track correctly. Shouldn't have if the ATO was publishing the fraction and the ratio or the percentage that they should have been using each year. But it sort of became difficult based on different cost-based elements within each year that might have been incurred and whether you're also adding indexation to those amounts because the goal is to bring it up into today's dollars. So after a little while, the government stepped in and go, okay, like we need to update this. This is becoming too difficult and too complex for accountants to use. So bringing in that straight line 50% CGT discount on the net capital gain was the easiest way to do so. But
Yep.
now, I guess where we stand right now is everyone's saying, well, that's still unfair in terms of the concession. It's caused a lot of property investing. It's pushed up property prices. It's caused the housing crisis, or it's one of the factors causing the housing crisis that too many property investors are benefiting from such a large concession that now they're thinking, well, do we unwind this a bit? And obviously that's being driven by Labor. That's more of a Labor stance. It's been on their shopping list for probably a little while now. So that's where it sits.
Yep. And I guess if you think about it, if you held an asset and you sold it and you sold it 13 months later, you get access to the 50% discount. If you sold it 10 years later, you still get access to the 50% discount. So yes, I guess by having a blanket rule, some people that have that transaction are going to have a much greater benefit of that discount versus if you hold it for a long time where it's more reflective of that adjusted value for inflation purposes. But I guess
Mm.
let's just unpack, an example here. So there's a couple of different CGT discounts proposals.
Hmm.
One is the 50% where it currently sits. We have the Henry tax review back in 2010 had a 40% discount. I think back then the idea was that was a bit more palatable politically, but I'd
Mm.
imagine that's not considered in this current environment. We've got there's some treasury modeling around a 33% discount.
Yeah. Yep. Yep.
And then finally, we had a 25% discount, which is what the Bill Shorten Labor government took to the election in 2019. So we know that
Yep.
they're probably where it may sit. And, we've
Mm.
got some numbers here if we want to break them down.
Yeah, absolutely. So, um, if we're considering, I guess, selling a property asset, and I don't want to just reflect this on expats alone because I've got to remember that if you're a non-tax resident right now, an Australian expat, like you can't tap into what's called the main residence exemption anymore. They removed the CG discount concession back in May 2012, so can't access that right now, but it's going to have this flow-on effect where if you're not an expat yet, but you're going to go overseas in 2 or 3 years' time, but they legislate something, it's going to change the way you calculate the taxable capital gain. If you're just living in Australia, ordinary resident, and you live in and you're buying and owning investment properties, then, if we're just doing a really easy straight line calculation, let's say you sold an investment property in Sydney, you made a $400,000 capital gain. Under the current legislation, you're discounting it by 50%. So what actually is you're paying tax on in your tax return is 200,000. So you're discounting it by 50%. And
Yep.
then if you were looking at just no other income in that year except for the capital gain, then your tax that you're paying on that 200,000 is $90,000. So out of the capital gain, you're paying $90,000. You're walking away with 310,000 in the gross or net capital gain after tax. And then off you go. So it is a great little concession when you look at the tax versus the total gross gain that you're making.
Mhm.
What about the 1/3 discount?
Yeah. So again, you'd have a taxable gain, which would be increased because we're only getting a 33% discount. So it's 268,000. Tax payable now would be 120,600. So we're paying essentially additional 50% tax on the current scenario. So our tax payable will be an extra 30,600.
Yep. Yep. So tax goes up quite quickly there in terms of the amount that you're paying. And then lastly, if we look at the bill short model where you are only getting a 25% discount, then your taxable gain would be 300,000 out of the $400,000 gross gain, but then your tax is 135,000. So it's going up again on the original figure of 45,000. So significant difference there. One thing I could see happening here, if they did play around with the CGT discount concession, is people getting a lot more creative with tax structures.
Yeah.
And what I mean by that is right now, if you were to use, say, a company structure to invest in property, because the capital gain is passive in nature and it's not a trading company of any sort, so it's not operating a business, that's what I mean by that, then the fixed tax rate that you pay on the gross gain is always 30%. You don't get any discount concession within a company, unfortunately, but that's the difference between paying a flat tax rate than not.
Yep.
But 30% is pretty good, but I could see there if it drops down to sort of that Bill Shorten model of 25%, might have a lot of investors going, oh, hang on, it's actually more tax effective, tax efficient to use, say, a company to buy and hold investment properties rather than investing in an individual name. I think there'll probably be some use around more trusts as well, and then using families to distribute to different individuals in the family to reduce your tax. That's the benefit of tax minimization strategies by using a family trust.
Yep.
But I could see people getting a lot more creative here with using different investment vehicles.
Yes, definitely, definitely. I mean, you just have to think about a couple of things in your personal name from an investment point of view. This current government did rip up the legislated stage 3 tax cuts. So that means that if you think about it, if you're on the top marginal tax rate, and you would be, in this example, if you had a $400,000 gain and you've got some other income, it's going to put you in the top tax bucket.
Mm-hmm.
By removing those legislated tax cuts or adjustments, it just means that any future gains, everyone will be paying a higher marginal tax rate because it hasn't properly adjusted up for that bracket creep, which was addressing some of it. So again, it goes to having it in other entities where you're not subject to that. So again, it talks to kind of overall tax reform. They're doing this piecemealing. They're doing a little bit on the super. They're going to do something here on capital gains or going to try. They may try and have a go at trusts again, or that maybe try and have a go at self-managed super funds a bit. But I think it goes back to, are we going to see greater tax reform as part of this? So if you're going to implement this, does this, on the other side, do you give individuals more of a flatter tax rate? I mean, they've gone back in the first term saying no, but I think the time is to have that conversation. If a company is getting that 25, 30% flat rate, should we look at that more on an individual basis as well?
Yeah. I mean, I've always liked the idea of dropping individual marginal tax rates, perhaps increasing VAT and GST. Just because you are putting more back into the consumer's pocket, but then it still comes back to you by way of the GST side. And then obviously you've got your state taxes, your payroll taxes, all those sort of things. Just because I think right now everyone would love more in their pocket, given the cost of living just keeps creeping up, and everyone loves to keep spending.
Yep.
So I think it's worthwhile, but we'll just see. Labor, I just don't know. Well, I can't see Labor giving too much by way of individual marginal tax rates. If anything, I think they're just going to change things and tax us more heavily on investments and passive
That's
income.
right. I mean, they could also look
Um,
at sort of reducing some of that expenditure on the
yeah,
other side.
that's right, mate. They're pushing it all up to their fault. But I wanted to now fire two quick questions of you from a couple of our listeners. This expat, just to do a bit of Q&A, but I'll read out as it presents. I'm an expat. I'm earning 150,000 USD with two investment properties. I listened to one of your episodes recently on the change in the DTI rules. So that stands for debt to income rules. How will this affect my refinancing?
Yeah, great question. So when looking at DTI, so that's your debt to income ratio, we'd be looking at converting your foreign income to Australian. And a lot of the bank, well, most of the calculations with the banks, they will shade that back and use the shaded, 20% discount to calculate that gross income on their personal or their PAYG income. We can also factor in the rental income on the two investment properties, and that will work out in terms of the DTI and where you sit. Now, I'm not seeing this being an issue, the DTI. Very few expats are actually kind of breaching that 6 ratio. What you'll find is they will have a servicing shortfall before they hit that. So I guess to answer that listener's question, you're probably going to run into a servicing shortfall before we hit that DTI cap of 6, number one. And number two, people can still have refinance loans approved above 6. So there is still the ability for banks to take those applications on, particularly if you're just refinancing a dollar for dollar and you're not trying to access additional lending. There's a bit of flexibility there. So I wouldn't be too concerned about that DTI.
Makes sense. Sorry about that. That's good. What about this one? I feel like we've just unpacked this a little bit, but
Yep.
should I sell my Sydney investment property? It was a former main residence before the May budget, just to avoid these potential CGT changes coming.
Well, number one, we don't know, like nothing's been legislated, so
Yeah.
just hold fire. I know, and James, you can speak to this a little bit. There were expats that rushed out and sold properties when the main residence
Main
exemption
residence.
changes came through, and
Yep.
of course, I
Yep.
think people reflected back on that, particularly in some of those markets, and they missed out on substantial gains on those properties. So I would
Yeah.
hold fire.
Yeah, it's a tough one. A lot of the time when they introduce these proposed legislation through budget, they do take a couple of years to get through. Main residence exemption is a perfect example. That was brought up in the 2017 budget and then legislated as of 30th of June 2020. I know personally, like we had some clients that chose to sell because some of them didn't think they were actually coming back to Australia. So it's their last opportunity to release like a concessionally taxed asset. Some did sell and then reallocated the capital to like investments. They were able to give some money to kids and other things. So, and then we did have some that just panic sold, even though we said it's probably not right if you do sell. So it really just depends. But yeah, it's too early to make that decision. I probably wouldn't sell. I'd
Mm.
wait until you hear the budget, and then there's going to be a lot of commentary, consultation on that kind of potentially proposed CGT changes. So it'll take a little while, but it's also something that can track. I know if they announce anything, we'll be tracking it like a hawk because
Yep.
it'll impact our clients that are overseas and that are back in Australia.
Yep.
But yeah, I wouldn't panic sell. I wouldn't go out and try and sell your asset right now just because of something that might not actually happen.
Yep. And the other thing to that is obviously understand your why, like why you'd be doing that. Is it if it is to realize some money in a more tax efficient manner, perhaps you look at raising some debt against your assets. That could be an
Yep.
option. I think, personally, I think that's going to happen more and more where people look to release equity because obviously that's not triggering any tax impact on the Australian side.
No, it's not. Absolutely not. It definitely isn't. Some good questions there. So yeah, for our listeners, if you do have any questions, there is a form there. You can drop them in. We love unpacking them towards the end of each episode. Um, I'd say by the time this episode comes out, we would have seen a rate increase. That's what I'm betting on. But in the meantime, that's all we have for you for today's episode. Thanks for your time, Jeremy.
Thank you. Thanks, James. Thanks, guys.